All right. Well, welcome tonight, everybody. My name is John Mazzara. I'm going to be going ahead and telling you everything you need to know about buying a house tonight. Uh, a little bit about myself. We're going to see here in the next couple of slides. I'll tell you about my background. And again, if you have any questions, go ahead and type me a message in the chat. I'm going to open that up. And we are going to take a couple of breaks. Again, if anybody wants additional information or wants to go to another class, I'm going to be having two more over the weekend. Again, the first one tomorrow from 3 to 5 over at Boom Island Brewery, pizza and beer. And then on Sunday at Shields and Eden Prairie in their training room on second floor from 12 to 2. So with that, let me ask you a couple questions. As a first-time home buyer, do you feel concerned, stressed out, intimidated about the process, maybe anxious or uncertain, don't know where to start? Well, that's where I'm going to go ahead and clear all that up for you. So by the end of this presentation tonight, you'll know everything you need to know to go out and start the process. So who am I? My name is John Mazzara, and I started selling homes when I was 21, right out of college. So I graduated from St. John's and started selling homes as my first job, and I've been doing this now 39 years. In addition, I have a financial planning practice. And for about 20 some years, I had a mortgage company with my wife. So I have a mortgage, real estate, financial planning background. I work both sides of the river. I've sold over 1,200 homes personally. I'm a little bit slower at the moment, but I had been selling one home per week. And I work with both buyers, sellers, and investors. I'm very knowledgeable about the financing, so I'm going to be able to help you figure out what program or programs might work best for you. And once we work together, I'm determined to stay with you. I don't assign you to anybody. I work with you to find the right home. So when you're picking an agent, it doesn't cost any more to work with one agent versus another. So I'm going to tell you to choose wisely, whether it's myself or somebody else. What you don't want to do is work with somebody that's just gotten into the business that doesn't have the experience because you've never bought a home. You don't want to work with somebody that's never helped somebody buy a home or has done very little volume. They won't be able to give you the same amount of direction and advice. So whomever you choose, I would say choose wisely because you'll pay the same and you might as well get what you're paying for, which is the best representation. The average person moves maybe 3 times, maybe 5 during their whole lifetime. So it's not something that you're doing enough to become an expert on. And like I say, I do and have done a tremendous amount of real estate. So pick somebody that can guide you properly. One of the best resources that I like to give you to start is this website over here. You might want to feel free to take your camera out and take pictures or to write things down. Again, you are going to get a copy of the recording, but if you go to this website, MPLS, like Minneapolis, mplsrealtor.com, and you hit the market data tab, you're going to be able to do some research and look retroactively by about a month at what's happening across the metro area or in any area that you might be interested in. So maybe you're interested in Eagan or Apple Valley or a certain area within Minneapolis or St. Paul. You're going to be able to drill down and get that data. What I'm showing you tonight is a macro view, and it shows what's happening across the whole metro area and a little bit beyond. And what it shows is that the median sales price is approximately 370,000, up about 3% from a year ago. And if we smooth the data over 12 months, it went from 365 to 371, roughly a 1.6% increase. So those two numbers, 1.6 and 2.8, are right within kind of a normal range of what you might be receiving for raises and or to keep up with inflation. When interest rates were very low, homes were appreciating at double digit. Now that would be unsustainable at double digits because people's salaries weren't keeping up. One of the reasons that interest rates are higher today is they were trying to control inflation. I would say that the pricing of homes has definitely slowed, and the number of buyers in the marketplace has slowed. So in that sense, it's a good time if you're thinking about getting into the market. The competition is a little bit less than it had been in the past because of the interest rates. To give you an idea of what you might end up paying for a home, if you look at the percentage of original list to sale price, you see homes are selling at about 99%. So what that means is that if a home is priced properly, it will sell close to the list price. So I show you that and emphasize that because I want to make sure that you have the right expectation when you're making an offer. If you're in a multiple offer, you're going to end up bidding more than the list price, more than likely. If you're not in multiple offers and if the home is priced right, there might be a small degree of flexibility in the pricing or concessions from the seller, as evidenced by what you're seeing right here in the percentage of original list to sale. Months of supply of inventory, we have more homes than we did last year at the same time. We have about 20% more homes. So what are the steps to home ownership? Well, one is to come to a class to learn the process. And depending on where you get your financing, if you use some of the first time buyer programs, you're going to be required to take another class. It could be up to 8 hours, could be in person or online. The goal is to get you a pre-approval and specifically pre-underwritten, and there's a difference. A pre-approval would be where you would submit your documents online and then they would underwrite it electronically through what's called automated underwriting, and you would have an approval that later needs to be validated by an underwriter, meaning they're going to actually look at the documents rather than the computer. The actual underwritten process takes about 2 to 3 weeks, but when you're done, you're done. The automated approval means that you look good and you should be able to get approved if everything you submitted was interpreted correctly. And the risk is, what if it isn't? And that could change your approval, meaning you go from approved to not approved. The types of loans that you'll be looking at in the marketplace are conventional, VA, and FHA. Now, the last two, VA and FHA, are government insured loans, and conventional is not. It carries something called private mortgage insurance unless you put over 20% down. And then there's another type of conventional loan that's becoming more popular today called non-QM, which stands for non-qualified mortgage. That would be for somebody that maybe has an I-10 or somebody that needs less verification but has good credit and a larger down payment. So we have this whole series or types of loans called non-QM where things don't fit exactly perfectly into the regular conventional loan world, but the person is still capable of making a payment. It's just they don't fit the guidelines under the regular world loans. So anyway, there's non-QM in addition to the regular conventional. Down payment assistance programs, the acronym for that is a DAP, Down Payment Assistance Program. And there are so many programs today. There are more programs today for down payment assistance than I have seen in my 39 years of selling homes. It's that dramatic. And it's possible to buy a home with as little as $1,000 out of your pocket. And you can borrow the difference to be used towards the down payment and or the closing costs if necessary. So don't let money hold you back. You do have to have a certain level of credit and of course the ability to pay it back, meaning you have to have a job or an income. But don't let the lack of down payment hold you back because we can normally work around that. So once we get you approved for a loan, either with or without down payment assistance, then you get to go out and house hunt with your favorite realtor. We set up a search through the multiple listing service called the MLS. We put in your minimum parameters so that we catch everything. And then we go out and we look and we make offers until we get the right property. And then when we do, after we get it under contract, then you may decide to have a home inspection. And if you buy a condo or townhouse, you'll have a document review, meaning you get to review the rules, the regulations, and the bylaws, and you have 10 days to review them from the date of which you received them. That's by law in Minnesota. So it's kind of like a free look. Going into a condo or townhouse, it's under usually a set of rules, and people have to be comfortable, and so they want to make sure that you have enough time to review them. And then, after you're satisfied with both the inspection and the condo docs, then you order the appraisal and the title work, and the loan is reviewed. Everything is submitted to the underwriter for final approval, and you're approved. They sign off on it. You get to go to a closing and sign for about 45 minutes. At the end of that, you get the keys and the seller gets the check for their proceeds. And then you get to move in and plan which holiday that you decide to host. Here's kind of a graphic of those words. So here we are at the top tonight. We're getting educated. We're learning about programs. You're going to figure out what you can afford in your budget. Then you're going to get pre-approved or pre-underwritten, preferably for a mortgage. You go out and shop for a home. We'll set up your search and we'll start looking. Ultimately, we'll get a home under contract, and then we'll have the inspection. The mortgage approval will be done after the appraisal comes in. Then we go to the closing, and again, there's that party. So mistake number one is ignoring first-time homebuyer programs and incentives. First-time buyer programs will work with Freddie Mac, Fannie Mae, and FHA. So it's an overlay on top of these regular type of loan programs. A first-time buyer, interestingly enough, doesn't have to be somebody that's never owned a home. It's just somebody that hasn't owned a home in the last 3 years. So you may have friends or family members that used to own a home that don't. Well, they would be eligible as a first-time buyer if it's been 3 years or more. You will need to complete a class, and usually that's about 8 hours to get a certificate, and that certificate will allow you to go forward under one of those special first-time buyer programs. The reason they want you to go to a class is they want you to be successful. So with more information, you'll know how to be a successful homeowner, and that's why they require it. A first-time buyer program can be specific to your city or county. So it could be, St. Paul, Minneapolis, Eden Prairie, Woodbury, whatever, Edina. Or it could be Hennepin County, Ramsey County, Washington County, or it could be statewide. One of the biggest providers of down payment assistance is the MHFA. And that's the Minnesota Housing Finance Agency. Many programs are dependent on your income, and almost certainly they're dependent on your credit. Some loans are forgivable, some are deferred. Usually the first-time homebuyer money is in second position to the first mortgage, meaning it falls in behind it. So you're making two payments, one for the down payment assistance and one for the first mortgage. Sometimes, again, the down payment assistance can be a grant or a loan that'll be forgiven by percentages over time. Here's an example of how somebody could use the Minnesota Housing Finance Agency down payment assistance program and how it could be used to cover the majority of the purchase of home. Under this example, we have somebody buying a home for $250,000. They're going to put 3% down, and they're going to finance the difference. So $242,500 will be the loan, and then they're going to have closing costs. Closing costs are going to be roughly 2.5%. So in total, they're going to need $13,750. However, what if they don't have the money? Then they can borrow the difference of what they do have from the Minnesota Housing Finance Agency if they meet the other criteria. So $1,000 out of pocket, and they can borrow the $12,500 or $12,750, and you would have two loans. You have two payments. I have a quick question. It says, do you have to pay for this program? I don't know if I answered it clearly for you, but when you borrow money, you have to pay it back, and it may be deferred, meaning you don't pay it back until you sell your home, or it could be that you're making just the interest payments, or it could be that you're amortizing it, and some of them are forgiven. But this particular program, the Minnesota Housing Finance Agency, the one I'm looking at here, this is their $18,000 program, and that's a loan, so that's not forgiven. They do have other programs that are going to be forgiven, one of them being something called the First Generation Home Buying Program, which is new, which is coming out here in about a week and a half. We have a slide on it that we're going to cover in a little bit. I mentioned I work with different lenders on different programs. This is my beautiful wife here, Patty, and she works at Wells Fargo. She's been in the mortgage business for 25 or more years, initially with me and about the last 11 over here at Wells Fargo. They have a program called Dream Plan Home, and you can get a $5,000 credit towards your closing costs and appraisal. So that's an actual credit towards those items. It's not a loan. Edina, the city of Edina. is encouraging affordable home ownership. So they have a couple of loans. You might see towards the bottom, you can get up to 25% of the purchase price, not to exceed 90,000, or you can get $20,000 as a forgivable loan if you're first generation. Now, what does that mean? It means that your parents and grandparents didn't own a home. So if you come from a long line of renters, for example, you may be able to get that $20,000. So in addition, so the cities, a lot of the suburbs have programs too. It's not just the city. We have another question for the first time home program certificate. Yes, you would need to take under most, if not all, of the first time buyer programs. You have to get a certificate. There are different providers of those certificates, and each program will tell you where they suggest that you go, either online or in person. But yes, you will need a certificate if you want to use first time buyer money. The Minnesota Housing Finance Agency. So this is where I'd mentioned that $18,000. So they're saying right here, just like what I did a little earlier, you don't need 20% to get a home. You need $1,000. That's how this program works. They'll lend you up to the 18,000 if you need it towards the closing costs and down payment. So Minnesota Housing Financing Agency has helped a ton of people get loans. And I work with lenders and brokers and mortgage people that can help you if that's what you need. They do fix-up loans as well, energy loans. You can see that their income guidelines are relatively robust. So you don't have to be a low-income individual to utilize the Minnesota, Housing Finance Agency loans. They do have some that are for lower income, but this one here that is statewide is, pretty robust. This is the new big one that's coming. It's called the Forgivable First Generation Homebuyer Community Down Payment Assistance. There's one from the Minnesota Housing Finance Agency, and there's one from the state of Minnesota. One's 30,000, one's like 35,000. One forgives in 5 years, one forgives in 20 years, over 20 years. So working with a lender that can provide, if you're first generation, if you want to utilize that program, I can introduce you to a lender that can get you qualified for that program. Again, this money is just kicking off. This is brand new. Another program that's out there is with Movement Mortgage. They'll give you 3.5% towards your purchase. So it's 1.5% towards closing costs. And the other, well, it's a total of 3.5. But anyway, they have this funding available for you that they can provide. So if you qualify, and you can see there are some minimums, such as credit scores and debt to income ratios. But if you qualify, you might get some free money here too. So types of mortgages, a conventional loan, everybody and anybody is eligible. Same with FHA, everybody is eligible. However, for VA loans, only veterans. So if any of you are a veteran, then you could utilize a VA loan, which means that you don't have to put anything down. If you're not a veteran, you cannot. Underwriting guidelines will vary by lender, per lender, and sometimes they'll put an overlay. Now, what an overlay is an extra set of rules on top of the regular rules. FHA, for example, doesn't have a minimum credit score and hypothetically could do a loan as low as 500. However, many lenders won't. So if you go to some of the larger banks, they may say, well, our minimum is 620 or 640. Whereas I do have outlets that will go to those lower credit scores, but you have to have a larger down payment and a good reason as to why your score happens to be at that level. With a conventional loan, it's not offered or secured by a government entity. Instead, there are private companies, private mortgage insurance companies that will insure it. And so when you get a loan with less than 20% down, you have to make a monthly payment called PMI. But when you have been paying on it for over 2 years, and when your loan balance is generally at 78% or less, you can be asked to be removed from that PMI. So if your home appreciates, or you finish off the basement or remodel or something, and you've added value, you're able to get removed from that after a couple of years. FHA loans require mortgage insurance. It's called MIP, and all loans that are originated by FHA require that you pay the mortgage insurance. The purpose of mortgage insurance for either FHA or conventional is to incent the lender to lend you the money, because the lender knows that if you default, if you get foreclosed upon, that and they get the home back and sell it and take a loss, that the insurance company will cover them for a percentage of that loss. So that's why they're comfortable making a low down payment loan, because somebody's got their back if you don't make your payment. So benefit of an FHA loan, 3.5% down payment with a 580 score. We might be able to go lower, but with a larger down payment. Most lenders will put you at a 640. If you're not credit ready yet, it doesn't mean that we can't get you ready. So either you don't have any trade lines or you had a couple bumps in the road. Typically, after a couple of years, everything will be fixed if we start setting up new trade lines and pay on them accordingly. So the nice thing about credit is that it isn't forever, meaning it isn't good forever or bad forever. So if you happen to have bad credit now, let's work on that and get you ready. And in a couple of years, we might be able to get you into home ownership. Sellers under FHA can pay up to 6% of the closing costs. Now, just because they can, of course, doesn't mean that they're going to, but it's allowed. So you might be able to factor that or work that into a transaction if it's required. Low mortgage rates. So FHA typically has pretty low rates, sometimes lower rates than conventional loans. So that may be a reason that somebody would gravitate towards an FHA loan. FHA also sometimes allows for higher debt to income ratios. Now, you're always qualified against your income for a certain percentage towards housing and your other debts. FHA allows you to use more of that income for a house, which means you can have a higher debt to income ratio. You can get a 15-year loan, a 30-year loan, an adjustable rate or fixed with FHA. And down payment assistance programs work with FHA. So FHA is down payment assistance friendly. Here's another grid kind of going over them. Minimum down payment FHA 3.5%. Minimum with conventional 3. Minimum credit 500 on FHA. Minimum conventional 620 to 640 generally. Maximum debt to income ratio, usually around 50%, really under both programs. The loan limit is smaller under FHA. It's just under 500,000. And for conventional, before you go into what's called a jumbo loan, it's 726,000. There is no income limit. You can make $1 million a year if you want. There is no limit. But for some of the down payment assistance programs, they have a maximum income, meaning you can't make over a certain amount in order to be eligible for that program. And sometimes we can switch to some of the proprietary loans. There's for example, if you make too much for MHFA, we might be able to get it done at one of the local large banks because they don't have that same requirement. And they have a similar program. The minimum out of pocket, again, you can buy a home today with as little as $1,000 using the Minnesota Housing Finance Agency. And so again, that's what keeps people as renters longer than they should be, is the fact that they think they need a larger down payment. You really don't. You will have mortgage insurance if you don't put 20% down, but you certainly don't have to wait and save for it. If you look at the cost of waiting versus buying today, if homes are on an upward trajectory, regardless of the rate, as long as they're appreciating, every day that you wait costs you more. So I would encourage you from a value perspective, equity growth perspective, to consider home ownership sooner than later, because it's probably not going to get less expensive to buy a home. It's probably going to get more, especially if interest rates drop and more people enter into the housing market. You're going to see the homes that are there get snapped up and people bidding and pushing them up, like they did earlier when rates were under 4%. Other places you can get money, we talked about them, the down payment assistance programs. You could also get a gift from a parent or a relative. If you have a 401k at work, you can take the lesser, generally, of 50% or 50,000. You would need to talk to your HR and your 401k provider. Most of them would give you a home loan to buy a home. We're under that 50% or 50,000 rule. If you have an IRA, you can take a distribution of $10,000 and not pay a penalty. If you take money before age 59 and a half, for example, out of an IRA, you'll pay a 10% penalty. But you won't have to do that, pay the penalty, if you use it to buy a house up to $10,000. And the other place that you could get the money is from the seller, i.e. the seller could pay through the purchase agreement, they could pay some or all of your closing costs. It might be a function of the actual offer. So let's say the home is listed for 250 and you want to get 5,000 in closing costs. You may say, well, okay, I'll pay you 255 and now you pay 5,000 the closing. So you can increase the price sometimes as long as it appraises for that value. Here's what you can't do for a down payment. You can't borrow the money in any form. So it can't be a loan from a relative. It has to be considered a gift. You can't cash advance a credit card. You can't go take out another loan other than a down payment assistance loan to buy a house or have under the mattress cash. So because of money laundering and other things, the banks won't accept, the title company won't accept you bringing in a briefcase of cash. You have to introduce your cash into the banking system and you have to take it out of the bank. Now, some people like to keep cash at home. So what I would say is if you're one of those folks, get it into the bank in however you want, but get it into the system at least 2 months prior to you wanting to go ahead and get underwritten for the loan, because the banks are only going to look at 2 months average balances, and that's what they're going to use. A buyer's eligibility for a home is based on the underwriter reviewing your ability to repay. So that means you have to show that you have an income from which you can repay. Your credit report shows your willingness to repay. So if you paid everybody late, you're probably going to pay the bank late, and the bank doesn't want that. So your past is the only thing they have to base and predict your future upon. That's why a credit history is so important. And then they look at the home, the collateral. Is the home, eligible for, in its current condition, eligible for a home loan? And all three of those things, and that's determined by the appraisal. All three of those things go into whether or not you're actually going to get the loan or not. Okay, I'm going to open it up to questions and answers. If anybody has a question, go ahead and unmute if you'd like to speak it. Otherwise, if you would like to type it, feel free to type me one. And if you don't, then we'll continue on, but I'll give it a couple minutes here. No questions from anybody? Okay, I'm going to keep moving on. Here we go. Mistake number 2, not getting pre-approved before you view homes. So we talked about the pillars of mortgage approval, your credit, your income, and your down payment. They all go together, from which the underwriter will make a decision. A loan pre-qualification, again, they're looking at your credit, your income, your assets. Getting pre-qualified before you look is the only way to do it. Otherwise, it will very likely lead to disappointment. Meaning, if you don't put forth the information to know what you can afford, you may end up looking at homes that are out of your budget, and it's hard to go back. So if you're looking at $400,000 homes and you're only qualified for 300,000, it's going to be hard for you to readjust your expectations, having been, having liked the $400,000 homes. There's going to be a difference at the 300. So I'm just saying one of it will be disappointment, but the other thing is the time factor. So you don't want to waste your time, and I don't want to waste mine. So we want to make sure that we're only showing you homes within the range of which you actually can qualify to purchase. A rough rule of thumb, depending on a moderate amount of debt, is roughly 4 times your gross income, as long as you're not self-employed. Otherwise, it would be your net income with add backs, like depreciation, for example. So if you made 100 grand and you're W-2'd, 400,000, 4 times 100, 400,000 is approximately what you would be eligible for in terms of a new loan. Okay, loan pre-qualification. Here are your do's and your don'ts. Well, number one, call us at any time so that we can answer your questions. Number two, continue living at your current residence. Three, continue paying on your mortgage or rent as you've been paying on time. Continue to use your credit as normal. Don't go out and make a large purchase which will affect your debt ratio. Keep working at your current employer, or at least within the same industry. Like, for example, if you were a nurse here or a nurse there, you're still a nurse. So that works just fine. But if you're going to work from, let's say, being a nurse to selling cars, that might be a problem because it's an industry that you don't have any history in. You want to stay current on all your accounts. You don't want to fall behind. And as you go through the process, expect that you'll be asked to provide any number of documents, social security card, bank statements, uh, loan documents of any other loans that you may have, or car loans. So you're going to have to provide documentation, and the loan process moves as fast as you can provide that document. So that's why I say getting pre-underwritten can take a couple weeks, because you might submit some documents, the underwriter looks at it, then the underwriter wants something else, and you go get that, you provide it, and so on and so forth. It can take a few weeks. And then once that's done, you're solid. You're good to go for a period of time. Then all we have to do is find the house and have it have clear title for you to purchase it. Here are some of the don'ts. You don't want to make any of the large purchases. You don't want to change bank accounts or have any large deposits that can't be accounted for. You don't want to do a lot of balance transferring or closing credit card accounts or consolidate all of your debt. You also don't want to make new application for credit or other loans or co-sign on anybody's loan or max out or overcharge on your credit card. So they want to see responsible use of debt, that you can handle your payments so that if they lend you more money, they know that they're ultimately going to get paid back. Okay, pre-approvals are underwritten, they review everything. Reliable, you can take a few weeks. It will tell you the maximum amount that you're qualified for. Now, you don't have to spend it. So let's say that we get you qualified for 400,000 for a number, but you're like, well, that, even though I'm qualified, that's more than I want to spend. Fine, we could always buy down, but we can't buy back up if we're not qualified for it. So I often suggest you get qualified for the maximum. And that way, if you choose to go up to it, you can. But then we're seamless, meaning we don't have to go back and be underwritten. The one thing about homes when they come on the market, if you like them, probably so does somebody else, which means we're probably going to get a multiple offer, and therefore time is of the essence. And the seller is only going to look at offers with pre-approved letters. So that's why it's so important to have that letter, because it could be the first time out that you look at a house, you want to make an offer, but if you haven't been through underwriting and you don't have that letter, you can't make an offer. So the loan is one of the very first steps, getting that in place. If you have your approval, you can shop with confidence because you know what you can buy. And when I set up the search, I determine that based on your letter. Your offers are really, you can't even make an offer without an approval letter, because a seller isn't going to negotiate with you or even consider your offer if they don't know that you can make it to the finish line. So getting pre-underwritten through the approval process is, I think, the way to go. Okay, mistake number 3, using the wrong lender. Not all banks work with or are approved to use the down payment assistance programs. Let's say you identified Minnesota Housing Finance Agency as the program for you. There are a list of lenders on the MHFA website. I work with a number of them that I feel are competent, the loan officers, and I could make an introduction to you of a lender that can get you that loan. But some banks or small credit unions, for example, are not approved. So if you walk into ABC Credit Union and you said, hey, I want to use the Minnesota Housing Finance Agency loan program, they may say, well, I don't ever heard of that, or it doesn't work, or you make too much money, or something to that effect, because they can't do it. So you need to be in front of the lenders that can offer you all the products, not the ones that can't. I had a client that unfortunately didn't want to change their lender, and they were saving for a down payment. I said, we can buy a home with $1,000. You don't have to wait another year and rent for another year. And they said, oh no, we got to save. So they saved, but then that home, because it was going up at that time at 10% per year, at 300,000, cost them 30,000 more than had they done it when they could have done it with a different loan program. Typically, a larger bank and mortgage brokers are going to have more resources and more options than the very small banks or very small credit unions. So I referenced it already, but if money is keeping you out of home ownership, don't let it. We can fix it. So it's all about balancing your situation. When do you want to move? What do you have for resources? What loans can you qualify for? And are there some assistance programs that we can utilize? Is a 30-year fixed rate always the best? Not necessarily. Maybe some of you today know you're going to leave Minnesota and move wherever within the next 5 years. If that's the case, you might find a 5-year or 7-year ARM that has a cheaper rate than the 30-year fixed. What if you find a home that's kind of dumpy, or you want to replace the kitchen or the bathroom or some items mechanically? There's a loan called the FHA 203K rehab loan, and there's a conventional rehab loan called Homestyle that can be utilized to do some work at the time of the purchase. So maybe you find the perfect home in the perfect area, but it needs more updating than you have resources for. One of these rehab loans could be used at the time of the purchase. Some employers have, because they're large and the bank is large, have partnered to give you things like $500 gift card or different things. Wells Fargo, for example, because they're of their size, has a number of larger employers that they work with that their employees get like a $500 credit. And so my wife can look up on that list and see if you happen to work for one of those companies. There's also a program for people that are union. So if you're in a union, there's a program called Union Plus, which also provides some special benefits for certain unions. The lender may have their own portfolio product as well. So sometimes what a lender will do if they're big enough is they may say, well, you know what? I like this program over here, and I like the quality of loans that they're generating. We're going to do something and clone it, but we're going to expand the income ratios, or we're going to do something slightly different, but yet we'll provide a viable product. And that's called a portfolio loan. What you're looking for, like with an agent, you're looking for somebody that has an extreme amount of knowledge that can guide you. And on the loan officer side, you're looking for somebody that can act as a counselor and ask what you need and then guide you towards and through these products. Because of the refi boom a few years ago, there were a lot of people that got in and be like, what's the rate? What's the rate? What's the rate? They would just quote rates. They couldn't give any guidance or overview of why you would want one loan versus another. And I call them rate quoting monkeys. With things being a little slower and the interest rates being higher, many of them have left the industry. But you want to work with somebody on both the real estate side and the mortgage side that has the experience, because you don't, we do, and we want to help you make the right decision. Okay, the next one, buying from a builder. So we can represent you 100% with a builder. All the builders' homes that are participating with agents are listed on the MLS, the multiple listing service. So when we set up a search, you're getting the new construction homes in your search, such that they meet your price range. So if there's a new construction in your price range, it will show up. Now, if you buy from a builder, which you can, you won't get any discount. However, what you won't get, so not only will you not get a discount, but you won't get any representation. And I think representation is important. I think that you need some guidance. The builder's agent in that model home is working for the builder. If I represent you or an agent represents you, then you have representation on that purchase. It will absolutely cost you the same amount of money, so why not get what you're paying for? An agent can show you all of the benefits and help you make the comparison between builders. For example, an M&I versus a Lennar versus a Pulte. We can help you do that, as well as make suggestions on floor plans, finishes, and other things, lot location, to help you make the best decision and where to spend your money. That's what an agent that's knowledgeable can do. So you want to be represented in all cases, in my opinion, by an agent. Now, sometimes what we'll find is that the builders are offering an incentive to use their preferred lender. And sometimes it can be a really good deal. So you may end up using their financing if they make it really attractive. However, we won't know that until we do a comparison. So we still go through the pre-approval process, but you could end up switching to the builder financing if that's the best deal for you. And that's what we'll help you figure out. Okay. Any questions on builders? Just real quick. Okay. Then let's talk about a home inspection. When you might want to skip it, when you might not want to skip it. Well, right here, I will never tell you to skip an inspection, but I'll tell you why people do, and then I'll give you suggestions, and it's always your choice, but I'll give you suggestions on why other people have chosen to waive it. So an inspection, when you have one done, the basic one costs about $500 or $600. It's about 50 pages. And you're hiring somebody to come up with and find all of the problems that are in that home. However, it doesn't mean that the seller has to fix all of them. It might be things that you do yourself over time, but you're aware of them. Hazardous items are typically fair game, meaning that we request that and the seller agrees, for the most part, to fix those hazardous items. But what an inspection does is it creates a contingency, because what you're saying is, I'll buy your home after my inspection and after we've worked through some of the items, if there are any. So it's really a contingent sale, because if we don't come to an agreement, then that home goes back on the market. That's why, all things being equal, if we have two offers on the table and one is with an inspection and one is without an inspection, we're probably going to select the one without, certainly if they're the same price, because that exposes us to a lot less risk. Now, if you're buying new construction, the builder has to get a certificate of occupancy, COA. They can't get that until the city has signed off on, the heating inspection, plumbing, framing, so on and so forth. So I don't know that having a new construction home inspected is the best use of your money, since the city's been doing it as they've been building the home and signing off, and won't give the CO, the certificate of occupancy, until everything is completed and up to code. So it might not be worthwhile. You also get a warranty when you buy new construction. You get what's called a 1-2-10 Howe builder warranty. 1 year on the appliances, 2 years on the mechanicals, 10 years on the foundation. So a builder has to provide that either in the form of a written insurance policy or their agreement to do so. Now, you may prefer the insurance. However, a young new builder may not have the experience that allows them to get insurance yet, which means you'll have to take their promise. But that's what a builder is supposed to cover in the length of time from which they are required to do so. The risks of skipping a home inspection if you choose to do so. Well, if you purchase a home and you're unaware of deal breakers or money bombs, there's no recourse. You don't get to go back, a year later and say, oh, well, I didn't check this and I didn't realize this, and now it's going to cost me money. So how about if you pay for it? The seller won't, because you bought your home as is, essentially, by buying it without an inspection. So you lose your negotiating power with them if you don't do it. You risk inheriting problems either that they knew of or didn't know of because you didn't test, you didn't find, and therefore you've accepted it as it is. You also are going to miss, if you have an inspection, some of those items that you might want to repair on your own in the future, but you don't know what they are yet because nobody's pointed them out. And then that way you can get your bids during the inspection period to know if you want to take on the cost of those projects. There might be illegal things, meaning illegal like additions done without permits or basements finished to a degree that permits should have been pulled and weren't. So those things could be costly if the city makes you redo them at some point in the future. Uh, I'm sure you've heard the word caveat emptor, which means buyer beware. So you have limited resources and the ability to solve the problems after closing. That's why typically you want to get all of this resolved during the inspection period. And the seller expects you to do that. So they're not adverse to inspections today. However, they they're going to be less willing to do things if the home is sold in a multiple offer, because if you're not willing to accept it, quite possibly the people right before you that lost in the multiple would be willing to go forward given that opportunity. Number 6 is skipping the condo document review. In Minnesota, you have 10 days for a complete review of the rules, regulations, bylaws, financials, and a resale disclosure certificate. Your 10 days don't begin until you've received a complete package. So if you're given things on a piecemeal basis, you didn't receive everything, and therefore neither have your 10 days begun. I'm going to show you a sheet here in a second that you can obtain from the publications link from the Attorney General's website. Now that 10-day free look that I mentioned for you to review the documents, it can be shortened to as little as 3 days by mutual agreement, but don't feel like you have to do it. However, if you can do it, that may allow the seller then to know that their home is sold because the review is another contingency, and therefore they can then go forward and purchase their own replacement home. They aren't going to be able to buy non-contingent until you've removed all of your contingencies, of which the inspection and the condo document review are both contingencies. Here's the document that I referenced. It's 4 pages. Today, this is the front page snapshot of the condo and townhome rules. And again, you can find that at the Attorney General's website. When we get everything set up, when you know how much you want to spend and where you want to be, then we're going to go into the MLS. We're going to pick the cities you want to live in. We're going to also pick the minimums of things that you're looking for. Like I need 2 bedrooms, I need 1 bath, I need a 2-car garage, whatever your minimums might be. And I typically like to cast a wider net, meaning going smaller on your minimums and wider on your cities. You can always eliminate them later, but I'd like to show you everything. And it's never really too early to start, because the sooner you start, the quicker you'll be educated to what that dollar that you're qualified for, that dollar value, will purchase in different cities. So 500,000 in Edina will purchase you a different home than 500,000 in Bloomington, and that'll be different than the $500,000 home in Richfield. You're going to get a feel for all of that once you start watching the listings. Also, there's a button in the MLS under each individual listing that we can click on to see which programs might be eligible for that house. So I just happened to pull up a listing. I clicked on it and I did a screenshot of it here. The property that I pulled up has 18 programs that are out there with up to $96,000 of money. Like I said earlier, I have never seen more opportunity for the ability to get money to buy a house. Things that I have for you, resources. I have a number of resources. This is my first time buyer book, Secrets for Successfully Purchasing Your First Home. It's available as a flip book or in hard copy. If you would like a hard copy, I need your mailing address to mail you one out. Otherwise, you could go to this address and put in your information and view it online. This is some of the things that we cover in the book: owning versus renting, needs and desires, getting that first home loan, first time home buyer programs, common first time buyer mistakes, searching for the right home, 12 steps to buying a home, hiring an agent or buy a loan, do's and don'ts of negotiations, what to know about home inspections, the closing process, moving tips for the first timer, and real estate horror stories. Oh, excuse me. I have another book for you called The Building the Case for Home Ownership Today. Compares renting versus owning. And then I have other books. So you may decide that at some point you want to invest in real estate. I have a couple of investing in books, and then I have a downsizing book and a selling book. So I have a number of books, whatever you might need. These are all available as flip books or hard copy. I also have a YouTube learning channel. So on my channel, I interview different lenders and other people that are involved in the real estate process. And you can Google my name or drop it in over in YouTube, or you can go to my channel specifically. It's right here. And here's the QR code that will take you to that channel. But it's a great way to learn about new options, financing options, and otherwise. So how do you feel now? Confident, informed, ready to get started? I am. So how do you do that? Well, if you'd like, you can book an appointment with me at minneapolis-stpaulhomes.net/book. There is no www in that. You just go without that. That'll take you to Calendly. Calendly, then you'll pick a date and a time, and then I will call you back to confirm, and so that you know that we're going to have that time together. My website, if you want to go ahead and do some bopping around on searches, is minneapolis-stpaulhomes.com. And so again, here they are again. And just, to sit down and talk, it doesn't cost you anything. We just book an appointment and we see, in about a half hour if I'm able to help, or if you need some resources for me to redirect. And then we'll have you get your financing in place, and then we'll circle back when you're done with that and start the search. This is what it looks like on Calendly. You go on out, you pick the date, you pick the time, you just click it and it goes right to me. We help everybody, regardless of race, religion, color, creed, or any other qualifying criteria. We help everybody, and I have lots and lots and lots and lots of programs that I'm happy to share with you. I also have a survey. So if you would like to take a 7-question survey, I will give you a travel certificate. Now, there are some costs involved in activating the certificate, but it's a great deal. You just pay basically the room taxes and fees at the place. There are no timeshares, and you can go to Las Vegas. There's another one from Mexico. So take the survey and then tell me you want the certificate, and I'll email that over to you. Just indicate to me if you want it for, let's say, Mexico or for Las Vegas. So you go back to that QR code, take the survey, and this just goes over the certificate terms. Here's a copy of my card. Feel free to take screenshots. Again, you are going to get a copy of the replay of this, but feel free to take pictures of anything. Does anybody have any questions? No questions? Somebody's got to have a question.